Joining us right now to talk more about the Fed, the markets, the economy, Bob Diamond, Atlas Merchant Capital, founding partner and CEO. Bob, it's great to see you. So curious just what your initial reaction was to hearing Jay Powell say what he said, and as explicitly as he said it, given that I think a lot of people thought that they would be trying to divine and read the tea leaves and read between the lines. In this case, it didn't seem like you had to do that at all.
Listen, I think it reflects the fact that I think he's delighted. I think the Fed is delighted. It was 18 months, 19 months ago when inflation was raging above 9%. 550 basis points in increases, unprecedented in 18 or 19 months. I think it was March 21 when they stopped buying $120 billion in treasuries and mortgages. So the progress over 18 or 19 months. And Andrew, to me, the fact that the economy is still growing, the markets, currency markets, debt markets, equity markets are all in balance. I was recently in Asia and recently in the Middle East, and the reaction around the world is, can this really be a soft landing? And so I do think, excuse me, I do think Jay Powell is feeling pretty good about the situation.
Would you have any fear that he is going to regret his words, meaning that we're going to get to some period in 24 and he's going to say, you know what, actually, inflation has not come down as fast as I thought, sort of the Jamie Dimon conundrum?
I think that's a real possibility, and I don't mean it in too aggressive a way. But if you said, you know, I'm kind of looking at next year and economic growth and inflation, economic growth will be a little bit stronger than the consensus, maybe inflation a little bit stronger than the consensus. So I do think the market's gotten ahead of itself, Andrew. It's kind of pricing in 3, 4, 5 rate cuts next year. I just don't see that right now. I think the economy is in reasonably good shape. So I do think the market's a bit ahead of itself. Yeah.
Bob, let me add to that. Ken Langone was here yesterday, and he just pointed out the fiscal spending that's still going to be taking place, that it's hard to fight inflation when you have a government that's still spending that much. And these are bills that were already passed, already put in place.
Yeah, absolutely. And you know, the consumer is still in pretty good shape. I think corporate balance sheets,
which, by the good way, is good news. We should look at it as such.
Exactly. And so we're talking about good things here. Is I think on balance, I think the economy will probably be a little bit stronger next year than consensus. So, you know, I would not be surprised if we don't have rate cuts next year.
I mean, I guess the issue from the Fed's perspective is, by their own concession, they were late in latching on to the inflation story.
No question.
And they don't want to compound that by also staying too tight too long, when, in fact, you already are starting to see some slowing. And when the policy rate is, at this point, so far above even current inflation rates, let alone the target.
Mike, I agree with you that they were late. Everyone recognizes that, and I think the Fed acknowledges it. The conclusion of that, in my mind, is they're likely to stay a little bit too long rather than exit too quickly. And I think if you go back in history, the bar for actually reversing course on rates is very, very high. So pausing is already in place. But if they move to start to cut rates, that's a pretty big move. And I think having waited too long and having seen inflation get above 9%, for choice, they're going to wait a little bit too long. And that's why I'm not quite as positive on 3 or 4 rate cuts next year. I just don't see that.
So, Bob, real quick, you know, for a very long time now, you're now in the private banking, private equity space. People have looked at the valuations of equities almost across the board and said, look, we're on the high side here. We're already on the high side. Now we're going to even be on the higher side. And so what does that do to how you think about either buying businesses right now, the value of businesses, and, you know, is there a crack in all of that? Or if you think that interest rates are actually going to keep coming down, is that going to continue to levitate the equity market?
You know, we look at the private markets, as you know, Andrew. So whether it's investing in middle market M&A platforms like Cascadia or Marshbury, we haven't seen kind of the valuation increases that you're talking about in the public equity markets. One of the things we're looking at right now is regional banks. And, you know, those are down significantly in terms of valuations relative to before March this year when we had the SVB, you know, the FDIC come in then. So we're not seeing valuations out of line in the private sector.